You're staring at your mortgage statement again. 3 a.m. Can't sleep. The number just sits there, mocking you. $500,000. Maybe it's $300,000 for you. Maybe it's $700. Doesn't matter. It's big. It's scary. And every single month, you write that check, $3,300, and you watch most of it, like 88% of it, just vanish into interest. Straight to the bank. Meanwhile, your college roommate, the one who barely passed economics, won't stop posting screenshots of their investment account. Up 12% this quarter. Index funds are crushing it. And you're lying there thinking, am I doing this wrong? Should I throw every extra dollar at this mortgage and kill it early? Or should I invest and let compound interest do its thing? This question keeps you up at night because the answer feels like it should be obvious, but it's not. And here's the thing, most people never figure it out. They either stay paralyzed, doing nothing with their extra money, or they pick one strategy, go all in, and then spend the next decade wondering if they chose wrong. But what if I told you the real answer isn't one or the other? What if the smartest move is actually both? And what if there's a simple rule that tells you exactly how to split it? That's what we're breaking down today. The Freedom Fund Rule, the F-squared rule. By the end of this, you're going to have a clear strategy for your exact situation, real numbers, real math, and zero guilt about whatever you decide. Let's go. My name is Charles, and I'm obsessed with how money actually works. Not the guru version where everyone's sipping smoothies on a beach by 35, the real version. The one where you're trying to build wealth while also not losing your mind over a mortgage that feels like it'll outlive you. Quick disclaimer before we dive in. This is education and entertainment only. I am not a financial advisor. I'm not your financial advisor. Nothing here is personalized advice for your specific situation. You need to talk to a licensed professional before making any major money moves. I'm just here to explain how the math works and why most people get this decision completely backward. Cool? Cool. Now, if you're getting value from this kind of no-nonsense breakdown, do me a favor. Hit that subscribe button. Smash the like. It genuinely helps more people find this stuff. And honestly, the algorithm loves it when you do. Plus, you'll get notified when I drop the next video, because we're just getting started on dismantling all the money myths that keep people stuck. All right, let's get into it. Here's the problem. You've got extra money. Maybe it's $1,000 a month. Maybe it's 500. Maybe you just got a promotion. Congratulations, by the way, and suddenly there's this gap between what you earn and what you spend. First time in your life. Breathing room. And immediately, two voices start screaming in your head. Voice one says, pay off the debt. Get rid of this anchor. Imagine waking up and owning your house free and clear. No bank owns you. That's freedom. Voice two says, invest it. Don't be an idiot. The stock market averages 10% a year. Your mortgage is 7%. You're leaving money on the table. Build wealth now while you're young. Both voices sound right. Both voices are backed by smart people with spreadsheets and data. And that's the trap. Because here's what nobody tells you. This isn't actually a math problem. It's a psychology problem disguised as a math problem. And the system, the banks, the investment apps, the financial gurus, they all benefit from you picking one extreme and ignoring the other. Let me explain. When you take out a mortgage, let's say $500,000 at 7% over 30 years, you think you're borrowing $500,000, right? Wrong. You're actually agreeing to pay back nearly $1.2 million over the life of that loan. That extra $700,000? That's interest. That's the cost of borrowing. And here's the part that makes people's heads explode. In year one, you pay almost $40,000 to the bank. You know how much of that actually reduces your loan balance? $4,000. $4,000. The other $35,000? Pure interest. Straight profit for the bank. They call this amortization. I call it a scam that's technically legal. In month 1, 88% of your payment is interest, 12% is principal. Even after 5 years of faithfully paying your mortgage, you're still sending 82% to interest. You won't pay more toward principal than interest until year 21. Year 21. For 2 decades, you're basically renting your own house from the bank. This is why banks love 30-year mortgages. They're extraordinarily profitable. And this is why paying it off early feels so appealing. Every extra dollar you throw at that principal is a guaranteed 7% return. Not approximately 7%. Not an average. Exactly 7%. With zero risk. Zero volatility. In today's world, where savings accounts pay 4% and bonds pay 5%, a guaranteed 7% is actually phenomenal. It's competitive with long-term stock returns when you account for risk. So the math says, yeah, prepay that mortgage. But wait, here's the other side. The stock market has historically returned about 10% annually. Some years it's up 30%, some years it's down 20%. But if you average it out over decades, you land around 10%. Let's be conservative and say 9% after fees and taxes. If you invest $1,000 a month at 9% for 29 years, and you bump that up 3% every year to account for raises, you end up with roughly $1.8 million. $1.8 million. That's retirement money. That's financial independence money. That's never worrying about money again money. Compare that to prepaying your mortgage. If you throw that same $1,000 at your mortgage every month, you pay it off in 16 years instead of 30. You save $380,000 in interest. Sounds great, right? But here's the catch. You spent $238,000 in extra payments to save that $380,000. Your net savings is $142,000. Not nothing. But it's also nowhere near $1.8 million. So investing wins by a landslide, right? Case closed? Not so fast. Let me introduce you to something called sequence of returns risk. This is the thing that keeps me up at night more than almost anything else in finance. And most people have no idea it exists. The stock market averages 9 or 10% over the long term. But you don't get 9% every single year like clockwork. The order in which you experience those returns, the sequence, matters enormously. Let me give you a real example. If you started investing in October 2007, right before the financial crisis, and you put in $1,000 a month consistently through 2008, 2009, and beyond, your annualized return from October 2007 to October 2015, 8 years, was only about 4.5%, even though the long-term average is way higher. But if you started investing in March 2009, at the bottom of the crisis, your annualized return from March 2009 to March 2017, also 8 years, would have been over 17%. Same market, same 8-year span, completely different results based purely on when you started. That's sequence risk. With a mortgage prepayment, there is no sequence risk. The interest rate is locked in. When you pay down principal on a 7% mortgage, you are guaranteed a 7% return. No volatility. No crashes. No sleepless nights wondering if the market's going to tank tomorrow. And here's another thing people forget. Taxes. When your investments grow, you eventually pay capital gains taxes when you sell. Even with favorable long-term rates, that's still a chunk going to the IRS. But when you pay down your mortgage, that savings is tax-free. The $142,000 you save in interest isn't reported anywhere. You just keep it. So now we've got a real dilemma. Investing gives you more wealth, but with significant risk. Prepaying gives you guaranteed returns and peace of mind, but less total wealth. What's the answer? This is where the F-squared rule comes in, the Freedom Fund rule. And it's beautifully simple. You do both. I know. You wanted me to tell you definitively which one is better. But here's the truth. Personal finance is personal. The optimal mathematical answer might be to invest everything. But the optimal mathematical answer doesn't account for how you'll actually feel and behave. Money isn't just spreadsheets and calculations. It's about sleep. It's about stress. It's about the story you tell yourself about your life. Some people sleep great knowing their money's invested, even if it's volatile. Other people can't sleep at all knowing they're deep in debt, even if it's good debt like a mortgage. Neither of these people is wrong. They just have different relationships with money and risk. And before we go further, if you're finding this helpful, seriously, hit that like button and drop a comment. Tell me where you're at in your own journey. Are you team invest, team prepay, or team I have no idea? The engagement actually helps this channel grow, and I read every single comment. Plus, it's just cool to see where everyone's at. All right, back to it. The F-squared rule says split your extra money between both goals. The exact split depends on your personal situation, but here are some frameworks. The 60-40 split. Put 60% toward investing, 40% toward mortgage prepayment. This leans toward wealth building while still making meaningful progress on debt. The 50-50 split. The balanced approach. Half and half. You're building wealth and reducing debt at the same time. The age-based split. Younger folks might do 70% investing, 30% prepayment. As you get closer to retirement, you flip it. 30% investing, 70% prepayment. But my personal favorite is the interest rate rule. This is where the math starts to give us real guidance. Here's the framework. If your mortgage interest rate is above 8%, prioritize prepayment. The guaranteed return is just too good. If it's below 4%, prioritize investing. The spread between your rate and expected market returns is large enough to justify the risk. If your rate is between 4 and 8%, which is where most people are right now, do both. The exact split is up to you. Let me show you what this looks like with real numbers. Let's say you've got that extra $1,000 a month and you do a 50-50 split. 500 goes to investing. 500 goes to prepaying your mortgage. Both amounts increase 3% annually to match raises. Here's what happens. With the prepayment component, you pay off your mortgage in about 21 years instead of 30. You save roughly $198,000 in interest. But you spent about $119,000 to do it. Net savings, $79,000. With the investment component, your 500 monthly investments, growing 3% a year, compound to about $842,000 after 29 years at 9% returns. But remember, when you pay off your mortgage in month 252, you can now invest your full mortgage payment plus the $500 you were already investing. That's about $3,800 a month for the remaining 96 months. That grows to an additional $462,000. Your total? $842,000 plus $462,000 plus $79,000 equals $1.38 million. That's actually pretty solid. You end up with $1.38 million, which is about $450,000 less than the pure investing strategy. But you also had the psychological benefit of paying off your house 9 years early. You got to experience what it's like to live mortgage-free while you're still young enough to enjoy it. You reduced your monthly obligations. You built flexibility into your life. And you still ended up a millionaire. Now let me tell you about two people. We'll call them Sam and Taylor. Both bought houses in 2015. Same price, same mortgage. $500,000 at 7%. Both got promotions a year later and had an extra $1,000 a month. Sam went all in on investing. Maxed out the tax-advantaged accounts, threw everything into index funds, didn't touch the mortgage. Taylor did the 50-50 split. 500 to investing, 500 to the mortgage. Fast forward to today, 2026. Sam's investment account is worth about $1.2 million. Impressive. But Sam's also still got 24 years left on that mortgage and is paying over $2,500 a month in mortgage payments. When the company had layoffs last year, Sam had a full-blown panic attack. All that wealth locked up in the market, can't touch it without penalties and taxes, and still drowning in monthly obligations. Taylor's situation? Paid off the house 3 years ago. Investment account is sitting at around 700,000. Lower than Sam's, sure. But Taylor's monthly expenses are half what Sam's are. When the layoffs happened, Taylor barely blinked. No mortgage, lower burn rate, options, freedom. Taylor took a 6-month sabbatical to travel, something Sam can't even consider. Who's winning? Depends on what you value. If your scoreboard is just net worth, Sam wins. If your scoreboard is freedom, flexibility, and peace of mind, Taylor wins. And this is the point. There is no universal right answer. There's just your answer based on your values and your life. Here are some situations where the math becomes crystal clear and you should prioritize prepayment over investing. High-interest debt. If you've got any loans above 10%, credit cards, personal loans, some car loans, stop everything and pay those off right now. You're not going to consistently beat 15 or 20% credit card interest in the stock market. That's not happening. Approaching retirement. If you're within 10 years of retirement, having a paid-off house dramatically reduces your required retirement income. You're not just saving principal and interest, you're creating massive flexibility in your retirement budget. Job instability. If your industry's shaky or your job feels uncertain, reducing your monthly obligations might be more valuable than building wealth. You can't make a mortgage payment with unrealized stock gains. Personal peace. If carrying debt genuinely causes you stress and anxiety that affects your health and happiness, pay it off. The psychological return of peace of mind might be worth more than any market returns. Nobody can quantify that for you. On the flip side, here are situations where you should probably prioritize investing. Low interest rates. If you refinanced your mortgage to 3 or 3.5% during the low-rate period of 2020 to 2021, you have essentially free money after accounting for inflation. Invest everything extra you can. No emergency fund. If you don't have 6 to 12 months of expenses saved in cash, build that before you prepay anything. Liquidity is crucial. No retirement contributions. If you're not maxing out your 401k match or your IRA, do that first. That's free money from your employer, and the tax benefits are too good to pass up. Young with time. If you're in your 20s or early 30s, compound interest is your best friend. The difference between starting to invest at 25 versus 35 is absolutely massive. Time in the market is your superpower. But here's what I realized while researching this. The spreadsheet doesn't actually matter nearly as much as I thought it would. I spent hours building models, checking formulas, making sure everything was accurate. And don't get me wrong, the math is important. But it's not the answer. Here's what I mean. When you walk into someone's newly bought home, what do you think? One person walks in and thinks, wow, they're winning at life. They own a home. They've made it. Another person walks into the exact same house and thinks, wow, they've got a 30-year ball and chain. They have to work for the next 3 decades just to own this place. That's basically prison. Same house, same mortgage, completely different stories. And the story you tell yourself matters more than any calculation I can show you. Some people feel trapped by debt. They can't relax, can't enjoy life, can't sleep well knowing they owe hundreds of thousands of dollars. For these people, aggressively paying down the mortgage isn't just financially smart, it's psychologically essential. The optimal mathematical strategy of investing everything is worthless if it makes you miserable. Other people feel trapped by not having liquid assets. They can't stand the idea of having all their wealth tied up in home equity that they can't easily access. For these people, investing provides flexibility, options, and peace of mind. The guaranteed return of mortgage prepayment feels like burying money in the walls of their house. Neither approach is wrong. They're different optimization functions for different people. The F-squared rule isn't really a mathematical formula. It's a framework for thinking about what you actually want from your financial life. The Freedom Fund isn't just the money. It's the freedom to design your life the way you want it. So here's my challenge to you. Before you open up that mortgage calculator or that investment app, sit down and write out what financial freedom actually means to you, not what some guru says it should mean. Not what worked for your parents or your friends, what it means to you personally in your specific life situation. Once you have that answer, the math becomes a lot simpler. The F-squared rule gives you a framework to execute on your vision, whatever it is. Here's your actionable playbook. Step 1. Figure out your interest rate zone. Above 8%, lean heavy on prepayment. Below 4%, lean heavy on investing. Between 4 and 8, split it. Step 2. Decide your split based on your personality and goals. If debt stresses you out, go 60 or 70% prepayment. If you're comfortable with volatility and want maximum wealth, go 60 or 70% investing. If you want balance, go 50-50. Step 3. Automate everything. Set up automatic extra payments to your mortgage. Set up automatic investments to your brokerage or retirement account. Don't rely on willpower every month. Make it automatic. Step 4. Revisit annually. Your situation will change. Your income will grow. Your risk tolerance might shift. Check in once a year and adjust your split if needed. Step 5. Protect your floor. No matter what you choose, make sure you have an emergency fund, at least 6 months of expenses before you go aggressive on anything. Liquidity saves lives. And look, maybe your answer is, Charles, I did the math and I'm going all in on investing. Great, do it. Maybe your answer is, Charles, I can't sleep with this debt hanging over me. I'm paying this thing off as fast as humanly possible. Also great, do that. The point is to make the decision intentionally, with full information, based on your actual values and goals. Not just because some video on the internet told you there was one right answer, because here's the truth. There isn't one right answer. And as long as you're making that choice deliberately, with open eyes, you're going to be just fine. Before I let you go, if this helped clarify things, subscribe if you haven't already. Hit the bell so you don't miss the next one. Drop a comment and let me know what you're going to do with your extra cash. Are you team prepay, team invest, or team split? I genuinely want to know. And if you know someone stuck on this exact question, send them this video. Share it. Help them out. That's how we build a community of people who actually understand how money works instead of just guessing and hoping for the best. The real catch is this. Hitting the number, whether it's your first 100,000 saved or your mortgage balance dropping below a certain point, that's not the finish line. It's the foundation. Protect your floor. Build your freedom fund. And remember, the best financial strategy is the one you'll actually stick with, not the one that looks best on a spreadsheet. Not the one some guru's shouting about. The one that lets you sleep at night and wake up excited about your life. That's the real F-squared rule. Freedom and function. Now go, make it happen.